makers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Bloomberg understands that the EU is seeking to conclude a preliminary trade deal with the US this week that would allow it to lock in a 10% tariff rate beyond the August 1st deadline. But President Trump has hinted that the deadline could be extended further.
I would say firm, but not 100% firm. If they call up and they say, would like to do something a different way, we're going to be open to that. But essentially, that's the way it is right now.
Now, for more on all of this, we have team coverage. Let's bring in Rufaro Chiriseri, Fixed Income UK Head at RBC Wealth Management, Rosalind Matheson, our EMEA News Director, and Brendan Murray, our Trade Czar. Susan Lynch, our Brussels Bureau Chief, also joins us. First of all, Brendan, I mean, letters were sent saying, look, he'd be happy with the kind of duties that he imposed, but at the same time, negotiations are open. What does the president want?
Yeah, well, 90 days was always going to be an optimistic timetable to put together any sort of comprehensive trade deal with each of the U.S.'s major trading partners. And what the president laid out in this letter, these letters yesterday, which were pretty much boilerplate for the various countries, just with different tariff rates in them, he said, look, there's essentially what he said was, look, there's more time if you want it, but if not, August 1st is the new deadline. So he basically said there's more flexibility than I initially gave. The July 9th deadline has been the marker that they have laid down for 3 months. So it's buying the administration a bit more time and some of these countries a bit more time to bring deals that had gotten bottlenecked at the finish line across the president's desk.
Yeah, and Rufaro, that's kind of like playing out in equity markets, but also in bonds overall. Is that there's a little bit of hope that actually negotiations can be ongoing and lead to a better outcome?
I think certainly when we sort of think of the reaction that we've seen in the bond market so far, it's been, I suppose, positioning for that sort of slightly better outcome, that a deal will be reached. We certainly don't see talks sort of breaking down in this sort of scenario, but we think there might be some concessions that may need to be made around perhaps some of these sectoral sort of aspects. So while there is good news, I think there's still some way to go.
And Suzanne, I mean, from the European Union side, they're trying to, to basically deal with this preliminary trade deal, and they want to carve out wine and spirits, aircraft and aircraft parts.
Yeah, and I think the key phrase here is preliminary. This would be a very broad brushstrokes kind of deal that the EU is trying to finalise before the end of the week with that 10% reciprocal rate. And as you say, they're trying to get some carve-outs for certain sectors. But in parallel to this, if you like, you've got the whole issue of sectoral tariffs. So tariffs on steel and aluminium, auto sector, even pharma tariffs. Now, they haven't come yet from the US, but the United States is investigating this and could impose pharma tariffs. They are kind of the big headache for the EU, because if they were to get this 10% rate, even with some carve-out, and get nothing on those bigger export products, those sectoral tariffs, well, then they have a problem. So I think the atmosphere here is quite cautious. I don't think it's necessarily seen as a huge positive that, it's been delayed once again. Germany in particular has been saying for the last few weeks very strongly that it wanted this wrapped up quickly. Now we have another extension now in the interim period to August 1st. So by no means, we're cut and dry on this yet.
Yeah, and Susanna, we also spoke to the European Investment Bank President Nadia Calvino. This is what she had to say about tariffs.
The constant change of position and the delay of the dates at which the tariffs are supposed to kick in, I think just confirms that a tariff war benefits no one. It is really a lose-lose proposition. And from the European Union, we have every interest in finding a good outcome that will continue to preserve free trade.
Roz, are partners just getting used to the fact that this is maybe the way that Donald Trump operates? He escalates and de-escalates, and at the end of the day, we'll end up with tariffs that the global economy can absorb.
Well, certainly with Donald Trump, nothing is final until it's absolutely chiseled into concrete. That's what we're learning, is that this administration moves very quickly, but also changes very quickly. And Donald Trump is very open to continuing to talk. And as we've been discussing here, like on the one hand, that buys countries time. On the other, it just extends the uncertainty over a longer period of time as well. And we can see from these initial frameworks that have been done, also they don't fix everything. So you've got these deals that he's announced with Vietnam, although Vietnam hasn't really confirmed that, with China and the UK. But even for the UK, implementing what they said they've agreed has been difficult. There are disputes still over steel. What defines steel? Where is it poured? That's very bogged down. And so you can see that even a very broad framework that the UK came up with, getting all of that bedded down is difficult. So for other countries still pushing this down the road, trying to get something that avoids a high level of tariff, but still going to be fraught with problems.
Yeah, and Rufaro, we're just getting, German exports actually sank more than anticipated. And again, this is because the value of shipments basically to the U.S. plunged to the lowest level in 3 years. When are we going to have more data points like this that point to actually chief executives not spending, cutting down on, some of the investment that they would have otherwise, and trade being shifted around?
Well, sort of looking at the German picture, we actually had some slightly more positive data yesterday. But of course, the front running that we saw in Q1, that's effectively borrowing from future quarters. We actually have a more positive view in terms of euro area growth in general. We're expecting growth of 1.3% this year. And that's really feeding through from that stronger than expected Q1 period. But also it's also the fiscal spending that we think will actually come through a bit earlier from Germany. And also ultimately it's that consumer spending as well, where we've had high savings in the euro area. We expect that to feed positively into growth as well.
Brendan, who's getting the tougher tariffs? Again, it feels like maybe it's a little bit more calculated than the first time around.
Yeah, it looks like they're coming in just a bit under what the original reciprocal rates were. So, time is on the side of the U.S.'s trading partners. I think one of the things that this 3-week pause will do, though, is we'll cut straight through the heart of this next earnings season. And the cloud of uncertainty that hangs over companies who are facing these tariffs are now going to say, we still don't have any visibility out into the third quarter or the fourth quarter into those costs. So while it buys time for trading partners, the companies that are paying these tariffs are still struggling to figure out how they're going to operate in an environment where they don't know what the future holds.
We also heard from President Lula of Brazil. Here he is.
Presidente da República de país do tamanho dos Estados Unidos.
A president of a country the size of the United States to go around threatening the world on the internet. It is not right. He needs to understand that the world has changed. No, we don't want an emperor. We are sovereign nations. If he thinks he can impose tariffs on countries, countries also have the right to do the same.
Ross, you hear this from a couple of leaders, especially from the emerging markets or from the BRICS countries. Is trade being fragmented, or is there a pool that's coming together in some part of the world?
Well, that's one of the reasons that Donald Trump doesn't like the BRICS, is because that group is expanding and it is accounting for a larger proportion of the global economy. But whether they can act as a proper group remains to be seen. We saw at the BRICS meeting that we just had on the weekend, some leaders speaking out, but others, frankly, trying to be very quiet when Donald Trump talked about a 10% tariff on BRICS countries for being anti-American. They didn't really want to engage on that. They seemed to want to let that fly by. So collectively as a group, they account for a lot of the economy and trade and output. Are they able to act as a true collective against the US? Unclear. Also some of these smaller economies just frankly don't have the clout, the ability to get a trade deal with the US. They kind of have to swallow what's coming. If you're a bigger economy, you can negotiate better. And so they're a little bit at the mercy of what the US wants here. But again, you can see from, Brazil has been quite vocal. South Africa was a bit vocal yesterday also. But again, the smaller economies, when you look at Cambodia, Myanmar is another one, a lot of these smaller Southeast Asian states, they don't have a lot of ability to band together to do anything.
And Rufaro, is this playing out actually on either, the fixed income or the currency markets for some of these countries?
I think certainly from the markets that we cover, looking at the UK market, we certainly haven't seen too much of a reaction in terms of that happening. given that the UK has a trade deal already. We did see sort of yields sort of track a bit higher across the UK and European markets as well as the US markets. But we think part of that was just a reaction to some of the jobs data that came out on July 4th. But I think predominantly some of the fiscal aspects may be the aspects that start to play into where yields go from here.
And Suzanne, when you look at the European Commission, of course, which handles trade matters for the EU, first of all, it seems that, Donald Trump and his team are okay to negotiate with them. We thought that maybe he'd come in and try and break them apart and play the leaders off each other. And, at the end of the day, would they get one of the best deals if things go to plan?
Well, that's what they're hoping. But, I mean, you're right there. It is the European Commission negotiating on behalf of the EU. But the EU member states, particularly those big countries like Germany and France, they all have to sign off on this. So, I mean, I don't think you're going to be hearing language like we just heard from President Lula from any of the big European leaders. But there is a conversation happening here about, how far should the EU hit back? They do feel they've leveraged. They've got sanctions ready to go if they need to. They've been holding back on that and they're continuing to. They don't want to escalate the situation. But I think there are a lot of nerves here. What kind of deal is this going to ultimately be for the EU? And if it's not good enough, are they right to sign up to it? We'll see if they sign this provisional agreement by the end of the week. That will give some calm to the situation. It will buy them more time. But those bigger questions remain about sectoral tariffs and other parts of the trade relationship.
In pure geopolitics, Ross, I mean, there's also two other, significant things that happened. So Benjamin Netanyahu nominated Donald Trump for a Nobel Peace Prize. I don't know whether that changes his thinking and also makes him cool off maybe on trade a little bit. And then the fact that we seem to have a reversal from the Trump administration on sending weapons to Ukraine.
Well, that's right. So all of this in Donald Trump's world merges together. So geopolitics, trade, these things all become one. And so your personal relationship with the president matters a lot. We can see that for Japan, for example, the late Prime Minister Shinzo Abe had a very good relationship with Donald Trump. And that did arguably diffuse some of the tensions over, paying for the US military in Japan, the trade relationship. And if you've got that rapport, it can help. And Benjamin Netanyahu clearly does still have that rapport with Donald Trump. There's been a few tensions there of late over the Middle East. Donald Trump frustrated that he hasn't got his ceasefire in Gaza, and we didn't see a lot of tangible progress in their meeting last night about that. There is a bit of a movement towards a ceasefire, but a lot of obstacles remain. Instead, he's trying to leverage the economic relationship in the region with Israel to get Benjamin Netanyahu to agree to the terms of a ceasefire. So it's about pushing on the trade and investment front there also.
So I wanted to talk about the UK in just a second. But Brendan, maybe first, what are you looking out for in the next couple of days? I mean, it's letters that get published on social media. But is there, are they telling these countries before face-to-face?
Yeah, I think the main thing is where are the deals? The president pre-announced the Vietnam deal last week. It hasn't materialized. If that doesn't get over the line by the deadline tomorrow, you gotta wonder what happened. And also, you mentioned the BRICS. What about India? They've been talking for weeks about how an India deal is close, and if that is now pushed back to August 1st, why couldn't they get that over the line? So I think the main question now is where are the deals?
Yeah, I want to talk about the UK. I mean, the UK signed, right? They got it. They have a deal, or are they still? They
have a limited framework of a deal that still has a lot of details to be worked through.
But I guess the problem is UK growth. Also, given what we heard last week with the benefits welfare fiasco and what that means for inflation and labour.
Mm-hmm. So I think from the UK perspective, if we sort of think of that growth picture, similar sort of situation as to what's happened in the EU. Q1 growth is essentially borrowed from future quarters. We expect growth in the future quarters to be lower in the UK. But then coming into that inflation picture, we certainly see that wage growth dynamic continuing to improve. Of course, the lagged data is not necessarily where it needs to be, that 3 and 3.5% level. But ultimately, the CFO data coming from the Bank of England survey points that wage growth is expected to trend towards 3.8% towards the end of this year. That should prove to be positive for inflation. And on that basis, we think the BOE could ease 3 more times to 350 at the end of this year. But of course, that inflation dynamic continues to be a risk to that view.
When you look at fixed income, does it really do these trade negotiations matter when it comes to choosing gilts over German bonds?
To a degree, and I think it just depends on the investor, depending on where they want to be exposed and their currency hedging costs as well that need to be factored in. But we think ultimately looking at the picture of fixed income across the board, we're certainly not a fan of holding ultra-long bonds, but prefer to be sort of shorter, intermediate part of the curve, just because of that fiscal sort of dynamic still playing out in that long end of the curve.
Okay, thank you all for joining us. I love team coverage on big days like this. Rufaro Chiriseri from RBC Wealth Management, Rosalind Matheson, our EMEA News Director, Brendan Murray, our Trade Czar, and Suzanne Lynch, our Brussels Bureau Chief. Now, coming up, deal-making activity is on the up. Maybe finally, a little bit, as loan issuance in Europe hits record volume. So we'll dig deeper on that. That's next, and this is Bloomberg. Now, deal-making has had a bit of a wild ride this year. 2025 began with confidence about an M&A boom under Donald Trump, only for this enthusiasm to be stamped out by tariff threats and trade uncertainty. But now, deal-making has found its footing again, with around $1.8 trillion of transactions in the first half of this year. Well, joining us now is Daniel Rudnicki, Schlumberger, head of EMEA Leveraged Finance at JPMorgan. Daniel, thank you so much for joining us. Look, there's a lot to talk about. How do you see the M&A pipeline for the second half of the year?
First of all, thank you for having me, Francine. It's lovely to see you, and indeed such a good time to catch up because so much has been happening. Deal making, M&A related pipeline for the second half of the year is getting better. We're seeing good signs. We've started to see some large cross-border LBOs coming back. Walgreens, Alliance Boots, 24 billion, Skechers, 10 billion. We're seeing now the contested takeover for Spectres, which is £5 billion. We've underwritten more new leverage financing in the past quarter than at any point in time since 2021. But still, it's very little in terms of the volumes we've seen year to date. It's only about 20% of the volume, which is a very, very low number compared to long-term averages.
Danielle, I mean, why is that? So strong. We've had definitely strong equity markets, and I don't know whether strong equity markets and heightened valuations mean that it's a good thing for M&A and IPOs, or whether they hinder it.
Well, let's put it that way. It depends on the sector. What we've seen is M&A or M&A for financial sponsors being concentrated in easier sectors. You've had to find this very volatile environment, sectors that are not too tariff exposed, that are not too cyclical, that show a little bit of growth. So the field of the possible has been reduced.
So given all of the risk appetite amongst banks and everything like that, can private credit also compete to finance some of the deals?
Yes, absolutely. And we've seen that in particular in April. April was a very interesting case study for us of what happens when there's a market wobble, right? During the month of April, we saw cost of leveraged debt increase by around 150 bips. And what we've seen almost immediately is private equity funds pivoting from broadly syndicated term loan Bs to direct lending loans, right? And that's why we've taken that into account. Now, our clients come to us for debt, right? They want debt cheap if possible. So that's why we've decided, JPMorgan, to do direct lending within leveraged finance. So we've got this pocket, about 50 billion, so that we can offer A or B or C, whatever the right solution is, depending on the market. I would argue that having private credit now almost makes our market safer because there's an escape valve to be able to continue to do deals and distribute debt, even if there's a market wobble.
Daniel, what can you tell us? So you mentioned, the Sycamore Partners buyout of the UK pharmacy Boots. I mean, I think you're sounding out investors for a mid-July launch for this $4.2 billion debt package. Is there investor appetite? Does it feel good, or does the tariff threats distract investors?
I mean, generally, there's very good investor appetite and lender appetite for debt, in particular in defensive sectors. And as far as tariffs are concerned, they're going to look at it name by name, right? You really have to do the analysis. And in a way, we're lucky in our markets because we can really open the hood, open the bonnet of what's happening in companies, and to figure out what is the real impact of this thing. That's a really, really good case study is what we did on Skechers, right? We did the analysis and we realized that under certain scenarios on tariffs, the impact on a pair of sneakers would be, just 1% or 2%, right? It's so it's very difficult from the outside in without doing the real due diligence to figure out what the real impact on companies is.
The problem is that we don't know at the moment. So I was speaking to the owner of a big drinks company that was saying, look, 10% we can absorb, 20% is going to be a little bit more complicated. So do you see a shyness, for example, a lack of investment for the future because of all of this uncertainty? And how does that translate into M&A?
So, of course, we're taking it into account. And of course, the volatility weighs on us. Yeah. Sectors that are more exposed to such volatility will be a lot more difficult to get transactions done in. So we are seeing that weigh in, yes, but at the same time, leverage finance is about debt, right? So we're less exposed than the equity markets overall. That said, it's the next couple of months the visibility for the next couple of months remains limited because there are just so many factors of uncertainty. And that's probably why we had such a huge refinancing wave in the past couple of months. I mean, it is literally crazy. We've issued 220 billion of leverage loan and high yield in the first 6 months of the year. That's a quarter of the European market refinanced.
Or do you see a lot more opportunities in Europe than elsewhere?
I think there's probably renewed interest in private equity funds for Europe, yes. Okay. Some funds have purposely decided to focus on Europe now. And then there are subsectors that also offer really, really interesting opportunities. Think about defense, for example.
So, and again, so is defense something where you're expecting possible M&A? Like, are there certain sectors in terms of leverage finance where you're generally much more optimistic than others for the next 6 months?
Yeah, I mean, defense, to continue on that theme, is a huge area of focus for us. Right? We've just done a 2 billion bond issuance in euros and dollars for CSG, which is the largest manufacturer of small ammunition to Czech company. That's a deal that would not have been possible 2 years ago. The needs in defense are just huge, and many SMEs in Europe, in particular, are finding it really hard to finance themselves, right? And our direct lending, we're doing a lot in direct lending with these companies, but it's at a scale that is hard to imagine. The CEO the other day was telling me, look, I've got 2 factories, I just need to build 2 more, right? So for defense in Europe, it's really a call to arms.
Thank you so much, Daniela Rudnicki, Schlumberger there, head of EMEA Leverage Finance at JPMorgan. Coming up, having revolutionized share ownership for retail investors, trading app Robinhood is rolling out blockchain-based tokens. It's not without controversy, though, so we'll be speaking to the Robinhood chief executive. That's coming up next, a conversation with Vlad Tenev. This is Bloomberg. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. President Trump fires off a new wave of tariff threats, but puts them off until at least August the 1st, while negotiations continue. Now, the EU rushes to seal a trade deal with the U.S. to lock in a 10% tariff rate. Plus, in a policy U-turn, Trump promises more weapons for Ukraine and rebukes Vladimir Putin for keeping up attacks. Now, Robinhood is credited with changing the game for U.S. retail investors, helping make it accessible to everyone. Now they're stepping into the world of digital assets with the launch of their own crypto tokens. Now, to talk more about that and its ambitions for Europe, I'm joined by Robinhood Chief Executive Vlad Tenev. Vlad, thank you so much, as always, for giving Bloomberg a little bit of your time. So first of all, have you had any inquiries, any queries from your local regulator in Lithuania regarding this offering?
Yeah, so what we announced last Monday in the south of France are several products for the EU stock tokens, which give exposure to public listed equities. We have over 200, and those are available 24/5, finally giving our European customers exposure to U.S. stocks. And then we did a giveaway of what we call private stock tokens of OpenAI and SpaceX. And those aren't tradable yet, but it's sort of testing the waters, if you will, for what we believe is a huge opportunity to resolve one of the biggest iniquities in capital markets, which is the fact that you have these massive companies that are staying private longer. In many cases, they're in frontier industries like AI, where we believe that could change everything, but retail investors can't get exposure. So we're working to solve this.
So the regulator in Lithuania, which you're regulated by, I mean, he looks at the offering and he calls you and asks you what?
Yeah, I think they have some questions. You know, they want to make sure that everything is proper because it's a new innovative offering, and we're confident. We think that these are not only important, but they'll withstand the highest form of scrutiny. You know, when Robinhood does anything, particularly if it's new, I think we expect that it's going to be looked over. So we do believe that it's important and will ultimately withstand the scrutiny. So we welcome the discussions with the regulators, as always.
Were they worried about risk or the way it was packaged? And have you been able to assuage, or is this just that? I mean, when are you expecting to launch some of these tokens?
Yeah, so at first they were in the form of a giveaway. Okay. So we gave away around $1 million worth of OpenAI tokens, 500,000 worth of SpaceX. And the idea would be to eventually allow for them to be traded by customers and also to greatly expand the realm of tokens that we offer. We'd like to have thousands of private companies on the platform accessible to retail. And actually, since our announcement, I've had a deluge of inquiries, private companies that actually want to access retail, to have their shares tokenized, to be a part of this revolution. So I think that it's going to be a thing. Of course, it's always difficult to be first, but I think this is so important that we're very motivated to find a great way that satisfies everyone.
And Vlad, did you speak to any other regulators prior to developing these or launching the stock tokens for private companies?
Well, so they're live in the European Union, not live in the UK or the US yet, although we're very keen to find a way to give retail exposure to private companies here. And of course, we have ongoing discussions with all of our regulators as part of the course of running a regulated business.
And confident that they'll be happy with it? I mean, it'd be wildly exciting, right, if it were, for example, launched in the UK. What kind of things are they asking you to do to make sure that it's fine to do?
Yeah, I mean, I'm not sure the full extent of their questions. They probably just want to make sure that everything's clear to customers. I think these are new products, and my assumption is they just want to make sure that they are available to customers and it's clear what customers are getting. So in that way, I think we're very aligned because we want those same things. And we do think that the product is clear and is useful.
So, Vlad, how exactly are these tokens, the tokens are structured compared to the underlying assets?
Yeah, so the way tokenization works is we hold the underlying, or it's held by a U.S. broker or other traditional financial business. And then we have a tokenization engine, which basically mints for new tokens when customers acquire them. And if customers want to sell them, we burn the tokens. The mechanism slightly differs depending on the asset, whether it's a public stock or a private company. But the intent is for the tokens to be backed by exposure to the underlying asset in pretty much all cases.
So if it's a private company, how are you valuing it?
Yeah, that's a good question. Without getting into the details of private company valuations, there is a secondary market for private assets, and typically that market is institutional or high net worth in nature. So institutional investors, high net worth, are exchanging private shares or private exposure to companies with one another on a negotiated basis. And so what this would do is it would unlock that. So it's not just the high net worth institutional market, but it unlocks it to retail exposure as well. And the innovation, the difficulty has not just been the sort of like accreditation requirements in the US, but it's also been how to get the liquidity. And I think that's where tokenization comes in, because it solves the liquidity problem by tapping into a global network of hundreds of millions of crypto market participants.
Vlad, on a very basic level, would you categorize these tokens as tokenized equities or derivatives?
These are derivatives, technically speaking, under EU MiCA and MiFID regulation. So what makes this possible now is clear regulations in the European Union for crypto assets. So it's a bit of a new thing. It's crypto assets, but also a derivative, and those two things are being put together.
I mean, in case of a dispute, inevitably there will be probably some dispute that comes up. I mean, will you intermediate in some capacity on these tokens, or is that one of the things that you're still trying to figure out?
Yeah, I guess it depends on what type of dispute. I think one of the big questions about things that have been tried before in this space is dividend rights, for example. And if you have these instruments, customers in the past have been denied the dividends. But we've actually managed to figure out how to give customers exposure to that. So we want to give all the benefits of the crypto technology and of holding the underlying assets with as few compromises as possible. Mm-hmm. And I think Robinhood is rarely sort of like the first mover in various spaces. We tend to have an approach where we like to make sure others sort of like do it first. And I think in this particular case, we think it's so important that retail has exposure to these companies and these assets that we saw an opportunity to give a robust offering.
And Vlad, I mean, you mentioned launching this in the U.S. as well. Is there a specific regulatory change that you need in order to get this done?
Well, for tokenization in the U.S., we do believe that the SEC has the authority to make it happen without legislation, which is interesting. And you probably saw last week Chairman Atkins of the SEC gave an interview about tokenization. He called it a great innovation. Mm-hmm. And we agree with that. We think tokenization is perhaps the biggest innovation to come into capital markets in the past decade. So I think the U.S. shouldn't be far behind. I think the opportunity is too large to ignore, not just for retail, but also institutional. And I think they're keen. They're having tokenization roundtables at the SEC, which we've been a part of. So
how quickly can we expect
hard
it?
to predict.
Yeah.
I think the challenge with the U.S. is we already have something that works. We have the traditional financial system. It's maybe not 24/7, which tokenization would allow, but it's 24/5. There's a lot of stakeholders that we have to make sure feel good about the change. I mean, we haven't even fully moved off of mainframe in the U.S. So I think it could take time, but I'd like to see the door opening for tokenization rather quickly. And I actually think our event should help accelerate that. Now that you see real products that are useful to customers with this fundamental technology, I think there's going to be more and more pressure for, industry partners around the world to adopt the technology.
Vlad, thank you so much for coming on. Always a pleasure to speak to you. Vlad Tenev there, Robinhood Chief Executive Officer. Now, Jane Street, thank you. Jane Street has told employees that India's securities regulator made many erroneous or unsupported assertions about the company's trading activity in the country. Now, in an email to staff, the U.S. proprietary trading firm and market maker said it strongly rejects the Indian regulator's accusation of index manipulation. Bloomberg has approached the regulator for comment. And the French President Emmanuel Macron is due to arrive in the UK later this morning for the first state visit by a French leader since 2008. There'll be lots of pomp and ceremony, but also plenty of serious talks on the agenda. Let's get more from Bloomberg's Alex Morgan. Hi, Alex.
Good morning, Francine. Yeah, goodness me, it is a packed 3 days, a blend of sort of soft power and thorny political issues. Let's start then with the issues that will be the shadows cast over all of the pomp, the ceremony and the scenes that we'll see. Top of the agenda, and this is migration. It is a huge issue domestically for the UK government. They, of course, have the right-wing Reform Party with Nigel Farage at the helm there, chomping at the bit to get going on this issue as small boat crossings across the Channel have reached a record high in the first 6 months of this year. The UK, Keir Starmer, looking through a thaw in the relationship with France and improvements in that entente cordiale to try and amend the return arrangements to tackle some of those crossings and hopefully turn a bit of a page there. Whether we'll get an inked deal on the issue of migration, it's unclear. But then you've got security and defence. Now, the two leaders will be chairing a call of the so-called coalition of the willing. You remember that's that group of nations hastily assembled when it looked like the war in Ukraine could come to some sort of pause or stop, requiring the UK, France, Germany to step in and support the peace. And then, of course, there is also this talk of growth and investment. The 37th Franco-British Summit will also be part of the leaders' meeting, where growth and investment is, of course, going to be something talked about. And I think the mood music, Francine, if we look to the agenda, you can get a sense of the kind of the pomp, the ceremony, with King Charles leading the way, a charm offensive, a welcome at Windsor Castle, not Buckingham Palace because of renovations taking place in London. The King, of course, himself, a Francophile, a fluent French speaker. You can imagine he'll be very much turning on the charm. And I think the emphasis you'll get from both Macron and Keir Starmer will be this sense of we've turned a page from Brexit. This is a new new UK-French relationship. And while there are these big issues, I imagine the two leaders at their joint press conference, which will round off the 3 days, will be really looking to those positive ties. And you can see it's the first visit from a French leader, first state visit since 2008. And my word, has the world changed since then, Francine?
Yeah, it certainly has. It feels like 5 lifetimes ago. Alex Morgan, some great reporting there on Macron's UK state visit. Now, President Trump says he'll ship more weapons to Ukraine to help the country defend itself. It comes after the Pentagon halted flows of some air defense missiles and artillery shells to Kyiv. Let's bring in our Russia economic editor, Greg Sullivan. Greg, good morning. So why did the U.S. halt supplies to Ukraine?
That's right. The U.S. earlier had halted supplies of air defense missiles and some artillery shells to Ukraine. The Pentagon said it needed to review its stockpiles. There was some concern over whether supplies to Kyiv could be diminishing greatly needed armaments. The Pentagon is now saying that what Ukraine needs most isn't urgently needed elsewhere. And of course, we heard from President Trump saying that he will provide weapons to Ukraine. He wasn't specific about what kind of weapons would be provided, though he did say they would be defensive in nature. Now, it's important to note that this comes against the backdrop of Trump recently talking to Putin, a call he said he was unhappy about, and Russia launching some record air barrages against Kyiv and other Ukrainian cities. They've been pounding these cities with missiles and drones, and they've been increasing civilian casualties. So some of that may have played into Trump's calculus in making the reversal of this decision here.
Greg, Bloomberg reporting that Russia has collaborated with Chinese firms to make drones. What can you tell us?
That's right. So drones have really become pretty central to this conflict on both sides. Russia has long sought to have the ability and know-how to really scale up its domestic drone production as drones become so much more important in the war. What the documents outline for us is really how some of this collaboration took place, how some of these sensitive technologies can find their way from China into Russia, and they really detail kind of from start to finish how these drones can be made and how some companies are actually trying to scale up production. In particular, there was one company, Arrowhit. The documents really showed how they used intermediaries to source some of these technologies from China, as well as deliver final products onto the battlefield, as well as some of the collaboration. Another interesting facet from these documents that Bloomberg reviewed was that a Russian delegation traveled to Harbin in 2023 and met with companies linked to Harbin Institute of Technology, which, by the way, Putin then visited in 2024. So really an interesting start to finish portrait of how Russia is trying to get these drones that it is now using to basically launch barrages on Ukrainian cities to try and wear out Ukraine and get Kiev to capitulate to its war demands.
Greg, thank you so much. Greg Sullivan there, our Russia economy and government editor. Now, coming up, we'll discuss the outlook for leisure tourism with the chief executive of theme park and attraction giant Merlin Entertainments. That's next, and this is Bloomberg. Welcome back, everyone. Now, global spending in the leisure travel market is expected to triple over the next 15 years. That's according to a new report. Now, a review by Boston Consulting Group estimates that the industry will be worth some $15 trillion by 2040. Now, that growth is being driven by emerging markets. Now, for some insight, we're joined by Fiona Eastwood, the chief executive of one of the world's largest theme park and attraction companies, Merlin Entertainments. Some of its most iconic attractions include Legoland, Sea Life, Madame Tussauds, and the London Eye. Now, it's just opened Legoland Shanghai, the first Legoland in China. So, Fiona, thank you so much for joining us. And you were just in Shanghai, actually, for the opening. So it's a great time to speak to you. China's going, I guess, through a little bit of a rough spot because of consumption, because of the decline in baby borns. Why do you still think it's a good time to be invested in China?
Well, I've just come back, as you say, arrived back on Sunday. We launched our fabulous new park at the weekend. And it's fair to say China has been challenged in terms of the economy the last few years. We've operated in China for just shy of 20 years, so we are at an advantage. We know the market. We've catered to over millions of guests. In terms of the market, there are good signs in the last few months. If you take retail spending as a good gauge of consumer sentiment, that has been up in the last few months 6.5%. I think the analysts thought it'd be about 5%. And certainly we've just had a sold-out weekend in our hotel and our tickets. So we're feeling very positive.
I mean, do you worry about pricing, or is there how do you what's the secret sauce to making it successful in China, where you also have quite a lot of competition?
Yeah, I mean, it's a very competitive market, but it's also a significantly huge market. So if you consider Legoland Shanghai, it has 55 million people living within the drive time for the theme park. And then if you consider we've also built a themed hotel, that has 250 million people living nearby because of the high-speed train links that have been built to cater for the park. So it's very positive. In terms of pricing, as we've operated in Asia, this is our third Legoland park in APAC and our biggest at launch. What we've learned from all of our research, all of the millions of guests that have visited us over the last 20 years, we've priced accordingly. Right. At the same time, we also make sure there is a broad range of access in our pricing. So our annual passes, for example, is just the price of 2.5-day ticket, and they can visit all year round. So again, we're seeing really good signs in terms of our sales for that as well.
If you're not overall, what's doing really well across the world? I know that, there are some places where tourism is really hot, others less so, but are people worried about tariffs and trade and consumer spending in general, or are they quite happy to travel less but go to theme parks?
I mean, it's a mixed picture. So we're in 20 countries around the world with 130 plus attractions. So it's always very different. And what's brilliant about Merlin and all the years we've been trading is because we are perfectly hedged in terms of different economies and different types of incidents. We're pretty resilient. What we are seeing is the UK, Europe and APAC are pretty strong. There's some signs of slowdown in the US. However, we're very positive about the rest of the world, and we price and market accordingly.
Is there anything that surprised you? Do people book tickets a little bit later than they used to? Again, we all change our habits and kind of, travel differently to what we did pre-COVID.
We're definitely seeing differences post-COVID. People are booking much later. In some markets, we are seeing even hotels on the day being booked. But again, because of our scale and because of our much-loved brands that we work with, there's a high demand for our business in a lot of the markets.
So what are you most excited about for the next 12 months? And what are you most worried about in terms of of what you have to do to get your priorities right?
I'm really excited about launching Legoland Shanghai. It is our biggest at launch. It's our 11th Legoland park, and you're going to see much more of that from Merlin in terms of scaling our much-loved brands. We have Lego, which is the biggest toy brand in the world. We did a deal last year with Minecraft, which is the biggest gaming brand of the world. And we also have several Pepper parks around the world, and that's the biggest toy brand. So I'm really excited about the brand partnerships.
And what you have to get right, because it's not an easy environment to do business in general because of all of the unknowns. And, I imagine that investing for the future is a little bit harder than it was even 12 months ago.
Yeah, to some extent. I mean, ultimately, all of our investments, because they're high capex, are made over the long term. And we're very fortunate with our shareholders. Kirkby and Blackstone are in it for the long term. So we make long-term decisions, like, for example, Legoland Shanghai. That investment was in 2017. And whilst there's been some economic turbulence in between, we know that that's a big bet. And those are the big bets we make in all of our big markets. We're also heavily invested in major cities around the world, such as London, Singapore, Sydney, Orlando. And those are all markets that cater to families that want togetherness.
How do you look at AI? So does it replace, I know I've heard you say that it won't replace the roller coaster because the thrill of the roller coaster can never really be quite matched, but does it change how you think of rides, or does it help with queues? That's what people really want to know, the queues.
I mean, AI is fantastic. And as with every company, we're building various use cases. We've already our Merlin Magic Making team have been using AI in terms of rides and in terms of creativity. But it's probably got the biggest role in terms of back of house, how we become better, faster, and more pace in our decision making based on AI. But of course, we'll also be using it in park in terms of improving the guest experience around queuing and other elements as well, in making sure our ride maintenance is also driven with AI as well. So there's lots of opportunities.
I mean, does it change, for example, food offerings and things like that because it's quicker to predict? Or have you been doing it in-house anyways through algorithms and other ways? How life-changing is AI for you?
Not necessarily in terms of food and beverage, but it's more in terms of that back of house. So better predicting consumer trends, better understanding our customer base, what they're doing, making sure we've got a single customer view. That will all be powered by AI and, like I said, make faster decision-making and really power our business decisions going forward.
Your ideal customer, is it families? And again, is it different in the US or in the UK than it is in China?
Well, we're very much aligned. If you think about our parks, so the Legoland parks, that's 2 to 12-year-olds, that's about families. Why Merlin has been so resilient. At the heart of the Lego brand, it's about learning through play, which has huge importance in nearly every market, but it's predominantly 2 to 12. Our other theme parks and our other attractions, such as Madame Tussauds, slightly aged up. And so we really cater from the toddler, Peppa Pig, all the way through to young adults and grandparents in terms of sea life.
I mean, do you see a lot of Americans coming for holidays? Does that show up in the figures at Madame Tussauds?
Yeah, it does, particularly the London Eye. I mean, the London Eye is that iconic attraction that all tourists see as a big part of their visit to London, as per Madame Tussauds as well. So we see US tourism is hugely important, in particular for the UK market.
Fiona, thank you so much for joining us today. That was Fiona Eastwood,
thank you.
Chief Executive of Merlin Entertainments. Now, we have, of course, a lot going on today. It's not only about tariffs. There's quite a lot going on when it comes to President Trump and what he wants to do going forward. This is the picture overall for markets. So stocks seem to be holding up pretty much firmly as Donald Trump's administration's latest tariff announcements also seem to give way to a little bit of optimism that there's ample room for further negotiations. So a full roundup of the markets, also focused on everything that we're seeing on spiraling global trade war. This is the picture that we're looking at the moment, with Nasdaq futures gaining 0.3%. Up next, a Bloomberg brief, and this is Bloomberg.